it's been now a year since the Biden administration enacted the Inflation Reduction Act. The historic U.S. climate law has made nearly $400 billion available in clean energy and created jobs. The move has also helped bring down prices, but the administration is struggling to get credit. Nathan King explains.
Here at the White House, U.S. President Joe Biden in a very celebratory mood about the economy, especially on this first year anniversary of the Inflation Reduction Act. Even though that bill is perhaps badly named, essentially what it has done is pump hundreds of billions of dollars into the U.S. economy over the last year, especially when it comes to green initiatives, from electric vehicles to even lowering the price of prescription drugs. It raised taxes, for example, on companies, on billionaires. It's a huge hodgepodge of Democratic agenda, and he really owns it. You know, the Wall Street Journal, he said, and the Financial Times called his economic agenda Bidenomics. He now owns it and says it's working.
But inflation is now lowest point it's been in 2 years. It's lowest among the world's leading economies. Take every major economy in the world. We have the lowest inflation rate. At the same time, wages are growing faster than inflation.
The big problem for Biden going into re-election, of course, is that it may not be the case that inflation continues to go down, that unemployment is at a low level. But it's a real indication on this first year anniversary that the Inflation Reduction Act has actually done more to transform the U.S. economy, especially when it comes to the industries of tomorrow, very much more quickly than they'd envisaged. Maybe it's luck, maybe it's timing, maybe it's policy. We'll work it out. But of course, this plays out on the larger geopolitical stage. China, of course, is the world leader on EVs. When it comes to exports now, the US wants to catch up. There is a lot of investment going into reshoring manufacturing here, from semiconductors to semi-convertible automobiles. It really is a different economic plan than we have seen in the long history of America since the Cold War of neoliberal trickle-down economics. This is very much an investment in the future using taxpayer money. Whether it will work or not, well, the American people will decide that. Nathan King, CGTN, Washington.
Wall Street nervous for a second day in a row. John Terrett has more from the exchange.
After the closing bell on Wall Street on Wednesday, Cisco Systems, the company that makes the bits that drive the internet, gave us their latest set of earnings, and they were pretty good as far as I could tell, but when I checked, the market had them marked down by around 2%. Also, in the couple of hours before the close of trade on Wednesday here, we had the publication of the Federal Reserve minutes. Those are the minutes, the written minutes of what was said at the last meeting of the central bank a couple of weeks ago. And they basically showed more interest rate hikes likely in the coming months. So Wall Street had a pretty heavy sell-off in the final hour on Wednesday. These are the numbers. The Dow was down 0.5%, 180 points to stand at 34,700. NASDAQ down just over 1%, 156 points. S&P 500 down 0.8%, 33 points to stand at 4404. In the crypto arena, Bitcoin was down 0.25%, so was Ethereum, XRP down almost 2%. And in the day ahead, which is Thursday now, the big one, Walmart, will give us their latest set of earnings, and we'll hear from Tapestry as well, which of course is the owner of Coach and Kate Spade, these high-end products that people love to buy around the world in all the key capital cities. And of course, as of last week, Tapestry buying Capri. So they're now the owners as well of Jimmy Choo, Michael Kors and Versace. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
We'll talk about those Fed minutes and the markets and everything else. Thomas Hayes, founder, managing member of Great Hill Capital, a long-short equity manager based in one of my favorite cities, NYC. So last time we checked in with you, Thomas, you still had the bull in you. It's now a couple percentage point down, and we've got the inflation thing not figured out. There's some questions there, and we haven't solved Europe. Do you still feel the same way?
Well, I still have the exact same sentiment, Phil. Thanks for having me. And it was bullish But we also did say we expect during the period of seasonal weakness, August, September, 3 to 5% pullbacks, which will be bought. So here we are 2 weeks later, we're down 10 out of the last 12 days. And we've got 3 to 5% pullback, 4.3% right now during this seasonally weak period. But the part of the thesis, if you recall, was that dips will be bought because most managers missed the first half rally when the S&P was up 17% plus. And these 3 to 5% dips are going to have to be bought. So we're going to find out in coming weeks, do they show up to the party? What we saw in the Bank of America survey yesterday among institutional managers is that while the cash levels are slowly coming down, they're still dramatically overweight T-bills and underweight equities relative to their past 20-year history. So they are still going to have to play catch up. And we do think that there's opportunity to buy these dips of 3 to 5%. And we also think that those people waiting for a 10 to 12% correction will be waiting for a long time.
But couldn't the opposite be true? I mean, hedge fund managers like yourself get paid as a percentage of profits. So let's just say you make $100 million. 20 million is basically the profit that gets paid to yourself or your own hedge fund. In other words, you're doing so well this year, at some point, wouldn't these successful hedge fund managers want to lock in their gains, which essentially means locking in their bonuses for the rest of the year?
Yeah, well, many of the managers have underperformed because they were very bearish and they were very much in cash. And now they have to chase. And what we're finding, what we saw in earnings season here, with everyone coming in pessimistic, expecting negative 7.3% earnings, is if you back out energy, earnings in aggregate were up 3% year on year. GDP now was printed. The Atlanta Fed GDP is expecting 5.8% GDP for Q3. So this economy is firing, but you do have to find selective opportunities, and there are tremendous opportunities moving forward.
So the word is stronger for longer, and I'm referring to rates, and you can see that in what the 10-year is showing, because we haven't seen 4.25%, at least in recent memory. So I've heard numbers from 4.5% to 4.75% to maybe even 5% on the 10-year. Explain to our viewers why that matters, because people often ask me, and I give my answer, but I think you could probably do a better job. Why does it matter that the 10-year keeps moving higher, and why is that perhaps a negative for stocks?
Well, we're knocking on the door to the high yields from last fall. Generally, the higher rates go, the lower the present value of the future cash flows for stocks. I will say that from 95 to 99, we had a Fed funds rate of 6%, and we had one of the biggest rallies in history. So you have to take that with a grain of salt. But what we do find this time around is when that 10-year gets over 4%, things start to break. We saw it last year with UK. We've seen it a couple of times. So I think at this level, we're probably getting toward the top end of yields, and we will see these start to roll over. Keep in mind, we're putting $1 trillion of supply on the market in a very short period of time. So this may be an aberration in terms of the yield blowout in the short term and little short-term fear. But I would bet as we move towards the end of the year, as the market starts to discount cuts in mid to late 2024, you're going to see a compression in yields. You're going to see a bid in the 10-year. And I would not be surprised at all before the end of the year if the 10-year yield is 3.25 or less.
Am I, tomorrow or later this week, am I buying, selling, or doing nothing?
I think you're buying businesses with a durable moat that are dramatically on sale, and you're taking the long view. One of the ones that we like on this weakness is PayPal. PayPal is trading at 10.5 times forward earnings. They're going to grow earnings next year at 14%. Their 5-year growth rate is 17%. Their historic multiple is 35 times. Oh, and by the way, they just got a brand new CEO. This is the guy who ran half of Intuit, which has been a 25 bagger over the last 13 years, and he's going to bring his growth story to PayPal, and I think we're going to see very positive things moving forward. So you just have to be selective. You know, it's perfectly possible that the market could go sideways, grind sideways. We're certainly not going to get in the back half what we got in the front half. We're not going to get plus 17%. I think we're going to get plus mid-single digits, and the opportunity to make money is going to be under the surface with discrete businesses that are on sale but growing This business has compounded capital at mid-teens for over a decade. They're going to continue to do so and maybe even accelerate with the new CEO, Alex Chris.
Real quick, I know you follow banks. I know you follow the real estate market, of course, and you're long short. Yeah. What are we shorting?
We're shorting pessimism right here. I think there are too many businesses that have come down materially because of COVID, because of the COVID aftermath, that have created once-in-a-generation opportunities. And when you look at the PayPals of the world, et cetera, what I would be shorting, I would be shorting the counter-trend rally of the U.S. dollar. I think as we move into year-end, the dollar is going to resume its downtrend that it started in October, and that's going to fuel flows back into emerging markets. We've had the short-term counter-trend move. But that's going to reverse and normalize, and we're going to see good things in emerging markets in coming months.
All right, next time we're going to get to Asia and China. I could do this all day long. Thomas, we love having you. Thank you very much.
Thanks for having me, Phil.